Let's continue with mergers and acquisition. I'll move to question 11. The following information relating to the acquiring company Abhiman Limited and the target company Abhishek Limited are available. Both the companies are promoted by multinational Trident Limited. Promoters holding is available. What is Trident Limited is interested to do justice to the shareholders of both the companies. For the swap ratio, weights are designed to different parameters by board of directors. Book value 25% weight, EPS 50% weight, market price 25% weight. What is the swap ratio based on the above weights? Book value, EPS after acquisition. Calculate promoters revised holding, free float, market cap, number of shares, EPS and book value. If there is a bonus issue and a split. Please go through the question. Okay, now coming to this question is going to talk about multiple parameters for an exchange ratio. Doesn't matter much from an analysis point of view, it always remains the same. What we will ideally do is get the first parameter, book value, base value, exchange ratio, you will swap it and get the shares to be issued. For every parameter you will calculate the shares to be issued, and final shares to be issued is equal to shares based on book value into 25%, shares based on EPS into 50%, shares based on MPS into 25%. We are going to take a weighted average of 3 different answers. So we are going to get 3 different answers for the shares to be issued. The 3 different answers is because one is based on book value, second is based on EPS, third is based on market price. For all these 3 parameters, we will get 3 different answers. This is one new thing which you are going to learn. And another thing which you learn in this question is something called as free float market cap. Now what is free float market cap is shareholding by non-promoters. Public shareholding is called as free float market cap. So anything which is held by public is called as free float market cap. For example, in Abhiman Limited, what is promoters holding? 50%. Balance 50% is held by public. The value of public holding is 400 lakhs. The value of public holding is 400 lakhs. So the value of the entire company is going to be 400 lakhs divided by 50%. Why I need this? Then only I can complete that table. We'll start with total earnings, number of shares, EPS, P multiple, MPS, number of shares, market value. That market value is this 400 lakhs divided by public holding. Divided by public holding, because this is the value of the public holding. Once we are done with that format, I'll see whether I'm getting this. EPS will come in the format, market price will come in the format. I'll separately calculate book value also in the format. Book value refers to equity plus reserves and surplus minus any fictitious assets divided by the number of shares. So we'll calculate the book value also, and then I go to the next. Working note 1, working note 1, base data. Working note 1, base data. Working note 1, base data. Particulars. We are not going to write the merged entity because exchange ratio itself is going to be a difficult task here. That itself will take some working note to be done. So particulars, Abhiman, Abhishek. Let's try to get their data alone. Abhiman, Abhishek. Let's write the format which we have and then see whether we have that information or not. If not there, we'll see what is to be done. Let's capture the format which we normally use. total earnings, number of shares, EPS, P multiple, MPS, number of shares, market value of firm. As a practice, we normally use the word firm rather than company. So that's a practice in finance. You call it as Abhiman firm, Abhishek firm, rather than calling it as company. Now let's look at whatever is available. Fill that. Balance thing will automatically come. In that format it will come. We have share capital, no use, free reserves. Paid up value is there. Can you tell me what will be the number of shares? Share capital and paid up value per share. 2 lakhs and 10 lakhs. So we are doing this in lakhs, 2 and 10. Two lakhs and 10 lakhs. P multiple 10 and 4. P multiple is 10 and 4. P multiple is 10 and 4. Now we need to proceed ahead. We have done with P multiple. Now this free float market cap, listen, can help me in getting value of firm. Free float market cap can help in getting value of firm. With value of firm you will get MPS. With MPS you will get EPS. With EPS you will get the total earnings. So that is how this format is useful. So let's try to get the value of the firm, which is free float market cap divided by public holding, because that is the public holding. That represents the public holding. So market value of firm, 400 divided by what? 50%. 400 divided by 50%. Second one is 128 divided by 40%. Now you will keep going backwards and get the balancing numbers. Clear? Now only one thing I want additionally, which is book value per share. Book value per share. Book value per share, which is nothing but share capital plus reserves and surplus divided by number of shares. Share capital plus reserves and surplus divided by number of shares. Share capital plus reserves and surplus divided by number of shares. Share capital plus reserves and surplus divided by number of shares. This base data will help me in getting the exchange ratio. Any doubts on this? Can we proceed? Clear? Next, calculation of exchange ratio. Next working note, calculation of exchange ratio. Calculation of exchange ratio. Now, whenever we have more than one parameter, I cannot straight away get it. I'll have to apply every parameter and get it. We may require some 6 columns, 6, 7 columns, so manage space accordingly. First write parameter. You may require 6, 7 columns, so manage space accordingly. The 3 parameters which they have decided is book value, EPS and market price. So write them. Book value, EPS, market price. Book value, EPS and market price. Which is acquiring company, which is target company? Abhiman is going to acquire Abhishek. So next, base value. Base value 500:60. Base value is 500:60. Abhiman is to Abhishek. 500:60. EPS 48. 40:8. Market price 400:32. Any doubts on this? Exchange ratio, swap it. Exchange ratio 60:500. Exchange ratio 60:500, 8:40, 32:400. Shares to be issued. Shares to be issued. How many shares are there in Abhishek Limited? 10 lakhs. So now please listen. 10 lakhs into 60/500. 10 lakhs into 60/500. 1,20,000. 10 lakhs into 60/500. Based on book value parameter, you should give 1,20,000 shares. Then 10 lakh into 8/40. 2 lakhs. $32/400. 120, 2 lakhs and 80,000. Now what I have to give is 3 different answers we have got. That's where those weights come into picture. So last 2 columns will be weight and product. That's all. Weight and product. There is a weight given to every parameter. Multiply that. The total of the product is the final shares to be issued. Weight and product. The final shares to be issued is 1,50,000. Based on that, you can write the exchange ratio. What is the swap ratio? 1,50,000 is to 10 lakhs. Basically 0.15:1 is the final exchange ratio. What we have decided is 0.15:1. 1,50,000 is to 10 lakhs. Any doubts? Can we proceed? So we are going to issue 1,50,000 shares. Now they are asked what is the book value, EPS, market price of Abhiman Limited after acquisition. Same P multiple continues. Now either, if we ideally I should have left a space here. If you don't have adequate space there, then recreate this. You are going to write all of this again. Total earnings, number of shares, EPS, P multiple, MPS, number of shares, market value of firm, book value per share. All of this needs to be rewritten now because we want it for the merged entity. Particulars and merged entity. Particulars and merged entity. Particulars and merged entity. You will keep adding two items unless they give some synergy gain or some information. Otherwise, you just keep adding it. So total earnings will become 160. Number of shares is 3.5. 3,50,000. 2 lakh plus another 1.5 lakhs. EPS 45.71. That's the EPS of the combined entity. We have answered one part of the combined entity, which is EPS. P multiple continues to be 10. 457.10. Number of shares will be how much now? 3.5. Market value. You may have some slight rounding of difference. Whatever you get, you write it. If at all there is a rounding of issue, take care of it. 1600 is the value. Book value is net worth of Abhiman plus net worth of Abhishek divided by 3.5. Share capital plus reserves and surplus of Abhiman plus share capital and reserves and surplus of Abhishek divided by 3,50,000. This answers part 2 of the question. We get 457.14. Any doubts? Okay. Now at this point of time, I have a doubt. Any doubts till now? Any doubts till now? That has turned out to be same. Sometimes it can be. It's not necessary that it has to be same, but at times it can turn out to be same. That's more of a coincidence in this question. It's not, most of the question you will not see them to be equal. But there's nothing saying that it should not be same. It can be same also. Now, my question is, Abhiman Limited is saying, you have told us to issue 1,50,000 shares. Perfectly fine. But I'm giving a share worth 100 rupees. Whereas the other company had a share worth only 10 rupees. I'm giving a share worth 100 rupees. Whereas the other company had a share worth 10 rupees. Why don't I reduce the number of shares? Why should I give 1,50,000 shares? Because I am giving a 100 rupee share, other entity had only a 10 rupee share. So is our answer right, wrong? Should I give only 15,000? Why should I give 1,50,000 shares of 100 when the other entity had only 10 rupee shares? Should we reduce the number of shares? Could be I have to go and reduce the number of shares. Maybe we have done it wrong also. So I'm asking you the question. This is a logical question which the Abhiman Limited is asking you. Why are you telling me to give 1,50,000 shares when My share value is 10 rupees, other person share value is 10 rupees. Which one? No, the gain is fine. So gain loss is different story altogether. My simple question is, you told me to give 1,50,000 shares. I am fine with that number. The only question I am asking is, should I give 1,50,000 shares of 10 rupees then indirectly, or if I am giving 100 rupees share, why don't I give 15,000 shares? That's okay. So 1,50,000 is the number of shares. Whether this 110, should we do some adjustment? We are not required to do any adjustment. The reason for that is, when it is a 10 rupee share, the company is automatically penalized here. If it was a 100 rupee share, this would have become 1. The moment this became 1, your EPS would have become 80. Your MPS would have become 320. All of them would have undergone a change. If the face value per share, so I'll change it here. If this was 1 instead of 10, because what had happened is, we did 100 lakhs divided by 10. If it was 100 rupees, I would have done 100 lakhs divided by 1. If this is 1, this number would have become 320. If this is 320, this number would have become 80. So accordingly, the exchange ratio would have undergone a change. Accordingly, the exchange ratio would have undergone. In short, the face value of a share does not make any difference to my swap ratio. Whatever be the face value, one company 1,000 rupees, another company 1 rupee, whatever exchange ratio you get, you follow that. It hardly matters whether it's a 10 rupee share or a 1 rupee share. Clear? Any doubts in this? The face value per share, because in an exam scenario, you may get at times confused and try to see what is to be done with that. The simple logic is, if it was 100 rupees share, accordingly the number of shares would have undergone a change and the exchange ratio would have undergone a change. So my swap ratio will keep undergoing a change. My swap ratio will keep undergoing a change. Net, the basic thing which I know is, what would have happened is, if it was a 100 rupee share, means the number of shares would have become 1. The number of shares would have become 1 lakh and the exchange ratio would have been 1.5:1 rather than 0.15:1. Net you will get the same 1,50,000 shares only. Be it whatever way you do it, you will get 1,50,000 shares only, because your every number, it would have become like this: 500 is to 600, 40 is to 80, 400 is to 320. In this process, what would have happened is, when you do this multiplier, you would have multiplied with 1 lakh rather than 10 lakh. Now we have multiplied everything with 10 lakh. When you multiply with 1 lakh, again you are getting the same number. So in short, it hardly matters what is the face value of a share. Clear? Any doubts? In fact, I even wouldn't want to know the number of shares, because when I try to calculate the consideration, I just look into two numbers: EPS or total earnings into the PE multiple. That only will give me the market value. In between, all of this is company's policy. They want to do something, they'll keep doing it. Any doubts in this? Clear? Let's move to the last part. Calculate promoters revised holding, free float market cap, number of shares, EPS, book value, if some bonus share and split happens. Let's first do promoters revised holding. Now write promoters revised holding equal to now please listen. The main promoter for this question is Trident Limited. They were holding some percentage in both the companies. Abhiman, what percentage they are holding? 50%. Abhishek? 60%. Now in the combined entity, they will hold 2 lakhs into 50% plus 1,50,000 into 60%, whole divided by 3,50,000. For 2 lakh shares, I hold 50%. For another 1,50,000 shares, I hold 60%, whole divided by 3,50,000. Get the holding percentage. $2 lakh into 50% plus 1,50,000 into 60% divided by 3,50,000. 0.29%, 54.29%. Any doubts on this? Clear? Then free float market cap. Free float market cap. Combined entity, what is the value of the firm? Market value. 1600 lakhs into 100% minus 54. Public holding minus 54.29%. Holding by the public. Seven. Holding by public 1600 lakhs into 100 minus 54.29%. $100 minus 54.29%. Clear? Can we proceed? The last part of the question says number of shares, EPS and book value if they do some bonus issue split. Now let me first explain. I'll explain the calculation and I'll tell you why at all they are doing. Particulars. What are the three things they've asked? Number of shares, EPS, book value. Value as of now. What is the number of shares as of now? 3,50,000. EPS, book value 457.14. Now please listen. The moment I issue bonus share, they are going to issue bonus in the ratio of 1:2. That is, today we are having 3,50,000 shares. The 3,50,000 shares will go up by some number because we are issuing bonus share. So the moment you issue bonus share, number of shares will increase, EPS and book value per share will come down. Why will it come down? Because your total earnings anyway remain the same. The total earnings are anyway going to remain same. So now please listen. Two things are going to happen. Split and bonus. Split and bonus. Let me first explain. Because of bonus, what will happen is number of shares will go up by 1.5 times. How 1.5 times? Extra half share for every one share. So today what is one share now will become 1.5 share. Today's one share will become 1.5 share. Any doubts on this? So the one share will become 1.5 share. After that you are also doing a split. Split is what they are saying. 5 each fully paid. What is the current paid up value per share? 100. 100 rupee share will now become 5 rupee share. Basically, one share will become 20 shares now. One share will become 20 shares. So, one share will become 1.5 share. Then it will become 30 shares. 1 will become 1.5 will become 30. Any doubts on this calculation? You are issuing a bonus. Bonus, what is the ratio of bonuses? 1 share for every 2 held. Let's take as an example, you have only 1 share as of now in the company. Bonus is equal to 1 into 1 by 2. Bonus is equal to 1 into 1 by 2, 0.5 share. Post bonus now it has become 1.5 share. It used to be 1.5 into 100. Now you are making 30 into 5. You are making that as 30 into 5. Any doubts till now? Any doubts? The basic thing is bonus split can only increase the number of shares. Why they are increasing, I'll explain in some time. Now what is going to happen is, this will become into 30. This will become divided by 30. This will become divided by 30. Why you are dividing by 30? When I go to this calculation, as of now you have written 3.5 lakh shares. Now this 3.5 will change. It will become into 30. The moment you do this into 30, everything will automatically fall down. Everything else. So EPS will become 1.52, price will fall in the market, and this also so everything is going to reduce by 30 times and number of shares alone will go up by 30 times. EPS will fall by 30 times, but look at the calculation. Total earnings never changes. Market value of firm never changes. What changes is only your earnings per share and market price per share. That is why I normally don't even pay attention to these items, because these are of no use to me, because you will change the share accordingly, this will undergo a change. What matters is total earnings and P multiple are the total net worth of the company. Now next question, why at all a company will do? There's a company called MRF Limited. This company's share price today I think is it in some 60,000 rupees. Some 60,000 rupees is the share price. Now if somebody has a plan of investing 10,000, he is convinced on MRF, but he still can't buy it because each share is 60,000. Now if MRF wants to improve the liquidity of the share, what they can do is they can announce saying that I'm splitting my share by 20 times. What will happen is instead of one share of 20,000, now it will become 20 share of 3,000 in the market. So if somebody wants to buy, he can at least try and buy at 3,000 rupees per share. You want to improve your liquidity further, do a bonus on top of that. 1:1 bonus if you do, it will become 40 share of 1,500. I'm again telling you, value never gets impacted. It is only thing which gets impacted is instead of 1 of 60,000, you will call it as 20 of 3,000, 40 of 1,500, 60 of 1,000. So you will just change the number of share. Why are we doing this? If at all I want retail investors to buy into my company, because even if I'm convinced to buy MRF, I will not touch it, because I cannot afford to invest 60,000 in a single share at this point of time. So the basic rule is, why split bonus are done, it's only applicable, it should be only done by a listed company. Unlisted companies also keep doing it at times, but it doesn't serve any purpose. The only purpose of a split is to ensure or improve liquidity of shares, because if I tell you 60,000, you will not buy MRF, but if I tell you 60 rupees, you will buy MRF, because you will think, let me at least put some 2,000 rupees. That is possible, but who will invest 60,000 in a single share? So that is where, to ensure liquidity of shares, this come into picture. Clear? Any doubts on this? Any doubts? So simple thing is, you can write value as of now and then value post split and bonus into 30 divided by 30. Why into 30? Why divide by 30? If at all you want, you can show this calculation. As of now, we have 3,50,000 shares, 45.71 EPS, 457.14. Post split and bonus, Number of shares will increase by 30 times. EPS and book value will fall down by 30 times. Done. So today it is 1 share. You are making a bonus of 1:2. So extra half share. So 1.5 it has become. Then you are splitting your 100 rupee share into a 5 rupee share. So each share will give you 20 shares. 100 has become 5. So 1.5 will become 30 shares. 1 share became 1.5 because of bonus, became 30 shares because of split. 1, 1.5 and 30. Any doubts on this? Clear? We'll proceed. Go through question 12. Okay, now 3 subparts to the question. ABC wants to acquire BCD. They have given the share details. Calculate the increase in total value of BCD Limited resulting from the acquisition on the basis of the following condition. So for part 1, they are asking what will be the increase in the total value of BCD Limited. For that, first I need to know what is today's value of BCD Limited. Today's value is 20 into 5 lakhs. That is today's value. 20 into 5 lakhs. When it comes to the other entity, there are going to be certain benefits. What is the benefit they are talking about? Growth increases to 8% from 7%. So growth from 7 has gone up to 8, and I need to value this company now. Today's value is 100 lakhs. Because of this change in growth, I have to value this company. How do I go about doing this? How should we go about doing this calculation? You have already done all of this. Growth changes from 7 to 8. That I have to attach a monetary value against it. How do we attach a monetary value for that? Yeah, which one? You will use Gordon's formula. That will give you KE. Same KE will continue, but growth will become 8% and P0 will become a balancing figure. Working note 1, calculation of increase in total value. Calculation of increase in total value. Point number 1, BCD Limited's market price. BCD Limited's market price today. BCD Limited's market price today is rupees 20. Today is rupees 20. And the value of the company is 100 lakhs. And the value of the company is 100 lakhs. Value of the company is 100 lakhs. Next point, growth rate is likely to change. Growth rate is likely to change due to acquisition. Likely to change due to acquisition, and hence the value of the company will increase. And hence the value of the company will increase. Value of the company will increase. KE equal to D1 by P0 plus G. KE equal to D1 by P0 plus G. They have given current dividend per share. I assume it to be D1 with an understanding that this is a distant dividend. So the current dividend, if it's going to be paid immediately, it is D0. If it's going to be paid in 5-6 months, it's going to be D1. Institute has taken this to be D1, so I'll continue with that. 0.60 divided by, this formula is reversing your formula of your Gordon, okay? I'm not introducing any new formula, I've just reversed the formula of Gordon. 0.60 by 20 plus 0.60 by 20 plus 7%. K is equal to 10%. Any doubts in this? Clear? Now revised value. P0 is equal to D1 by KE minus G. P0 is equal to D1 by KE minus G. Your Gordon's formula, P0 is equal to D1 by KE minus G. So 20 rupee share will become 30 rupee share the moment the growth rate is increased. 20 rupee share. Which one? Ideally, yes, I should change, but I'm just continuing with what Institute has done. Ideally, D1 should undergo a change. So I should have brought down the 0.60 to the lower level and then added with the 8% growth. Ideally, that is what. This is one area where a lot of inconsistency is there. I'm proceeding with whatever they have done, but yes, logically, I should have done that adjustment. Revised value rupees 30. Increase in value equal to 30 into 5 lakhs minus 20 into 5 lakhs. 30 into 5 lakhs minus 20 into 5 lakhs. $50 lakhs is the increase in value. 30 into 5 lakhs minus 20 into 5 lakhs. The increase in value is 50 lakhs. That answers part 1 of the question. Increase in total value is equal to 50 lakhs. Clear? Can we proceed? Any doubts on that? Next, on the basis of aforesaid conditions, calculate the gain or loss to shareholders of both the company if AFC were to offer 1 for every 4 shares. How do we do this? 1 for every 4 shares, gain or loss. We have done all of this. I'm not teaching new stuff. When I teach new stuff, I'll explain in detail. So what, after number of shares, what will you do? You got number of shares, then. Okay, market value of the, so we'll start with market value of the combined entity first, which is entity A plus entity B plus synergy gain. What is synergy gain? That is extra 50 lakhs which we have calculated. That's the synergy gain. And then I'll calculate the number of shares, get the price, and then the other parts. Okay. Next, calculation of gain or loss. Calculation of gain or loss. Calculation of gain or loss. Combined entity equal to AFC plus BCD plus synergy gain. AFC plus BCD plus synergy gain. AFC is 10 lakhs into what was the price? 100. 10 into 100 plus 5 into 20 plus 10 into 100 plus 5 into 20 plus 50, 1150 lakhs. That's the value of the combined entity. Clear? Now I'll quickly do the gain or loss in a single chart. Any doubts on 1150 lakhs? Now listen. This is going to be split into 2 people. AFC, BCD. How many shares are there in ABC as of now? AFC 10 lakhs. BCD will get 1 share for every 4 shares held. So they are going to get shares of 1,25,000. Now this 1150 lakhs will be split in the ratio of 10:1.25. That's the value they get. The value which you write here minus 1000 is the gain for AFC. The value which you write for BCD minus the original 100 is the gain for BCD Limited. Clear? Any doubts on this? Now write value 1150, value of company 1150, value of company 1150 lakhs, 1150 lakhs. Split it into AFC, BCD, AFC, BCD, $10 lakhs and 1,25,000. This is 1022.22 lakhs. You're splitting in the ratio of 10:1.25. This side it is 127. 1022.22 and 127.78 lakhs. 1022.22 and 127.78 lakhs. Post merger, these guys are going to get 1022.22 and 127.78. This is the value they are getting post merger, less pre-merger. Less pre-merger value. What was the pre-merger value? 1000 and 100, and this is the gain for them. 22.22 lakhs, 27.78 lakhs. This adds up to that 50 lakhs benefit. 22.22 and 27.78. The benefit of 50 lakhs has been split into these two people in this value, 22.22 and 27.78. Check the final answer you're saying? No. This. Correct.
So, shouldn't it more or less be like 50 lakhs is shifted to BCD?
Why will it shift to BCD? Because BCD is getting that value because of AFC. Otherwise, the AFC shareholders will say, reject this deal. Why are you even doing this deal when I am not getting any benefit out of it? So, why should I do this? Why will I help another person? He is coming to my fold, and because of that, the growth is there. So, I also should get benefit. You also should get benefited. It is not that entire benefit will pass to one set of people. Then a deal will not happen itself. I have to convince both the set of people saying that there is a benefit in the deal for both of us. If both of us have a benefit, it's easy to pass through a deal. If only one of them has a benefit, then the deal may not pass through.
In that case, will it not correspond to the swap ratio, like 50 lakhs in the swap ratio?
No, it will not. So the point is, now we have done this 50 lakhs in the ratio of, you are saying 10:1.25? No, 50 lakhs in what ratio?
1:4.
The benefit for both the set of people has to be in the ratio of 1:4. Now you change the swap ratio to 1:3, assume. What will happen is AFC will lose money. It can even become a negative for one company. So it is not necessary that both the company has to have a benefit. You change the swap ratio a little, you will see a scenario where AFC loses money and BCD gains a huge amount. So I cannot divide that 50 lakhs in the ratio of swap. They can make a problem saying that this 50 lakhs has to be split in the ratio of 1:4 for both the people. If they tell that way, then this has to be 1040. This has to be 110. Overall put together we know, but the split has to be 1040 and 110 because you want to divide this gain in the ratio of 1:4. 10 lakh for one company, 40 lakh for another company, and accordingly calculate your exchange ratio. You have to keep changing your exchange ratio for this gain to be distributed in different numbers. So net your gain and swap ratio both will not be moving in the same ratios. Both cannot be in the same part. In fact, there is no way to calculate your answer. There is no way to check the answer. You'll have to do it. There's no way to check whether you have done it right or wrong. Except for few places. Wherever it is available, I'll tell you. But here in this question, you don't have a way. Now, coming to question C. Calculate the gain if AFC pays 22. P ratio does not change. EPS is 8. BCD EPS is 2.5. AFC invests cash to earn 10%. Now, listen. when I give a cash consideration, whenever a cash consideration is paid by a company, what will happen is the number of shares will remain same. That is not going to change. Now what price I am paying? Gain for BCD Limited is 2 rupee per share into 5 lakhs. Done, that's all. Gain for BCD is 2 rupee per share into whatever number of shares, which were 5 lakh shares. Every share you are paying 22. They are least bothered after merger what happens, because they are getting 22 and moving out of the company. They are getting those 22 rupees and moving out of the company. So whenever you pay cash, when we did first problem today, when the cash was there, I did not do any splitting and all. I took the cash consideration, subtracted the value and said gain is so much. For the other company, I have to do EPS calculation and all. I'll take you through how to do EPS calculation. Next, gain or loss in cash offer. Gain or loss in cash offer. Gain or loss in cash offer. Gain to BCD Limited. Gain to BCD Limited equal to 2 rupee per share. Don't bring that 1,25,000 and all into picture. That is for the part 2 of the question. 125 ended there, that's all. Every share 2 rupee extra I am paying. So BCD Limited guys are happy that they are getting 2 rupee per share extra than their original 20 rupees. So they gain 10 lakhs in this deal. Gain to BCD Limited. Now, when it comes to AFC, EPS of AFC today is 8. EPS of AFC is rupees 8. How many shares are there in AFC? 10 lakhs. Now, please listen. I'll tell you when to note it down. EPS post merger 8 into 10 lakhs. This is the earnings one company was making, plus I have acquired another company. Its entire earnings will come to me. Whether I am paying shares or I am giving cash, that's my wish. But entire earnings will come to me. 2.5 into 5 lakhs. 2.5 into 5 lakhs. 8 into 10 lakhs. AFC's earnings. 2.5. BCD's EPS is 2.5 into 5 lakhs. This entire amount is going to come to me, but the only problem is AFC invests its cash to earn 10%. What would have happened in AFC is that 8 rupee EPS you see, no, that will also include some interest income. So my earnings will move like this: 8 into 10 lakhs plus 2.5 into 5 lakhs minus 22 rupees into 5 lakh shares into 10%. 22 rupees into, because I paid that much cash. When you pay that much cash, that earnings will come down. You are not going to get, see, in this case, one thing which is very clear is denominator will remain same 10 lakhs. So when something is getting added, obviously something has to get deducted. If nothing is getting deducted and you are just adding some earnings, then every deal will be a good deal only. So to do a cash deal, you need money. That money was earlier earning you something. Now you will not earn that. So in this process, if your EPS goes up, your market price will go up and you will gain out of the deal. If your EPS comes down, your market price will come down and you will lose out of the deal. So you can gain or lose depending on the impact on EPS, because my P multiple is going to remain same. Again, I am explaining you. 8 into 10 lakhs is first company earning. 2.5 into 5 lakhs is second company earning. Ideally, in share deal, what will happen is plus something you will do here so that that minus was never there. But in this question, you are not doing plus something in the denominator because we are not issuing shares. When you are not issuing shares, you have to give money. When you give money, you lose interest income. Clear? Any doubts on this? So minus 22 into 5 lakhs into 10 percentage, whole divided by 10 lakhs. Clear? Any doubts on this? Do this and let me know. It's given no. You are currently earning your cash to earn 10%. So whatever consideration you pay to the other company, you will lose the interest income on it, because that consideration was giving you 10% earning. Your consideration was giving you a 10% earning and you are going to lose that now. If EPS moves up, market value will move up, you will gain out of the deal. If EPS comes down, you will lose out of the deal. EPS moves up to in a cash deal, denominator never changes, so your numerator has to come down by something. Any doubts on 8.15? EPS is 8.15. Your EPS of 8 rupees has moved up to 8.15 because the deal is EPS accretive. Either it can add to your EPS or reduce your EPS depending on how much you pay. I had paid 22. If I had paid 40 rupees, maybe my earnings would have come down. 30 rupees, my earnings could have come down. So it all depends on how much are we giving to the other person. Any doubts on this? Can I proceed? Now MPS 8.15. Can you tell me what is the P multiple of this company before merger? Before merger, after merger, everything is same. We have not done a detailed table, but I think you will be in a position to. P multiple. We have done so many problems. How much? No, it's not 10. How did you get 10? No. That is other company. No, I'm asking for this company. 12.5. 100 rupees of market price divided by 8 rupees of EPS. 100 rupees of market price divided by 8 rupees of EPS. It's 12. See, these are basics. We cannot keep recreating the table in all the problems. Otherwise, I'll have to keep doing the table in all the problems. It will take time. It is not that it's going to be difficult. If I had put it in a table format, you would have straight away told me 12.5. But you can search for that information and write it. So the P multiple is 12.5. The overall gain out of this deal is any doubts on this? Clear? Can we proceed? Any doubts on this? So the basic difference between a cash deal and a stock deal is, in a cash deal your denominator will not change, so numerator has to have some adjustment. Otherwise what I would have done is entity 1, entity 2 combine, add earnings, add share, get the number of shares and get the EPS. Any doubts on this? Can we proceed? Go through question 13. Okay. Now we are shifting to a cash flow based valuation model. So in this question it's going to be cash flow based valuation model. What works in cash flow based valuation model is how you value a perpetuity or how you do a discounting of cash flow. At IPCC level you could have learnt about how do you calculate NPV. So year, cash flow, PVF, DCF. I would have done this also under step up growth model for dividend analysis. So basically if a company has to be valued on the basis of cash flows, you need to get this structure, that's all. So this problem you are going to value it on the basis of cash flow. If it's a perpetuity, the formula for perpetuity, if they give information on cash flows, then create this format and value the company, that's all. So the basic objective is this format which is there, year, cash flow, PVF, DCF. It can be used to value any asset you want to. Somebody wants to value this building, I just need to write it like this. Year 1, I will earn a rent of 5 lakhs. Year 2, I'll earn a rent of 6 lakhs. Year 3, I'll earn a rent of 7 lakhs. Year 4, I'll earn a rent of 8 lakhs. Year 5, it's going to be 10 lakhs. At the end of year 5, I'll sell this property for 100 lakhs. If I can get this year and cash flow structure for any asset, be it any asset you want to value, be it land, building, plant and machinery, car, anything you want to value, any equity share, any debenture, preference share, anything which needs to be valued, you need this structure. Year, cash flow, intangibles, tangibles, whatever it is. If you can get the year and cash flow, PVF will depend on what return you need. Somebody will say, I want a return of 15% from this property. You do PVF at 15%. You want a 20% return, do PVF at 20%. 10% return, do PVF at 10%. Once you have created the structure, 1 divided by 1.15, divide by 1.15, it goes on like this. And my property value is done. So according to me, the property value is this. 72 lakhs. Somebody else may need a return of 10%, he will value the property differently. Somebody will say, no, the rentals is not 5, 6, 7, 8, 10. I believe the rentals will be 10, 12, 14, 16, 18. Different people can have different expectation. So all this I do, it changes from person to person, because different people will have different expectation, and because of that only a sale transaction or a transaction basically happens. I believe this property price will go up, I will buy it. You believe the property price will come down, you will sell it. So that is what basic rule. Whenever a transaction happens, both the parties need to have an opposite view on that company or opposite view on that asset class. So to cut it short, any asset you want to practically value it, try to get this. This is the easiest way of valuing an asset class. Year, cash flow, PVF, DCF. Any other method, Gordon's, Walters, all of that is applicable only for few types of, it is only applicable for equity shares. This I can use to value a building, value a computer. If somebody wants to value a computer, provided he is using it for productive purposes. So somebody is going to get cash flows out of a computer, then you can value it. Cash flows out of a car, you can value a car. Any asset which is going to give you any inflows in future. The basic rule of finance is, the value of any asset is the present value of future cash flows discounted at investors' required rate of return. Present value of future cash flow. So I need the cash flow for any asset. I want to value TCS Limited. I'll sit down, year cash flow. First year, they will earn this much cash flow. Second year, this will be the cash flow. Third year, this will be the cash flow. Fourth year, this will be the cash flow. Fifth year, this will be the cash flow. Thereafter, it's going to be a perpetuity with a 2% growth, 3% growth, whatever you want to do. You get the cash flows, PVF, what rate you want to earn, 10, 12, 14, 16, 8, 6. Get the PVF and do the value and see the current value of the company. You will know whether it's an undervalued company, overvalued company. Do you want to buy this company, sell this company? So in simple words, any asset class can be valued using this format, year, cash flow, PVF and DCF. Now coming to this question, ABC is considering the cash inflow after tax is estimated to be 5 lakhs. So this project can give you, this company can give you a cash flow of 5 lakhs. This forecast does not include some synergy gain. B Limited currently has 50 lakhs with 20% being financed with debt. Pre-merger weighted average cost of capital is, now they have said no, this 20% finance with debt. This is an irrelevant information for me because they have already given WACC. If they don't give cost of capital, then they may give cost of equity and cost of debt. We did EVA, there we had done a format to calculate WACC, source, cost, weight, product. So if the WACC is already given, let them tell me 100% funded, sorry, 80% funded with debt, 60% funded with debt, 10% funded with debt. It doesn't matter to me because you have already given me WACC. Now they are saying, based on A Limited's pre-merger cost of capital, what is the maximum purchase price? Maximum purchase price is equal to 5 lakh divided by 15%. 5 lakhs divided present value of perpetuity. Perpetuity amount divided by cost of capital. So I'll pay 5 lakhs divided by 15% and done with that. That's the answer to part 1 of the question. It's a perpetuity and they are saying you have to discount it on what? Pre-merger cost of capital, and the pre-merger cost of capital is 15%. Part 2 they are saying you will move to an optimal and WACC will be what? I'll divide by 12%, that's all. Earlier I was dividing by 15%, now I'm going to divide by 12%. So let's write maximum purchase price based on pre-merger cost of capital. Maximum purchase price based on pre-merger cost of capital. Based on pre-merger cost of capital. equal to cash flow divided by WACC. Cash flow divided by WACC. What's the answer we have got? 5 lakhs divided by 15% is 33 lakh. Okay, 33 lakh 33,333. Any doubts in that? Can we proceed? Next, revised price with optimal capital structure. Revised price with optimal capital structure. Revised price with optimal capital structure. 5 lakhs divided by 12%. 5 lakhs divided by 12%. 41 lakh 667. I can pay 41 lakh 66,667. 5 lakhs divided by 12%. 4166,667. Any doubts on this? Clear? Can we proceed? Now third part, the cash flows are not that easily given. I have to do some calculation. Now please listen. Estimated to be 15 lakhs for the coming year, will grow at the rate of, for the following 2 years, each rupee increase in cash flow will require 0.7 incremental investment in assets. Estimate the maximum purchase price based on 12% cost of capital. Now listen for some time. I need to create this structure. Year, cash flow, PVF, DCF. Year 1 we are going to get 15 lakhs. Year 1 it's going to be 15 lakhs. Year 2 is 15 into 1.2. It will grow at the rate of 20%. So it becomes 18, but it doesn't stop there. They are saying if your cash flow increases, let me keep it like this. Investment in assets and net cash flow. Though my cash flow will go up from 15 to 18, the problem for me is that this 15 to 18 increase, 3 rupee increase or 3 lakh increase will have to be compensated by increase in investments. How much investments I have to do? So 2.1 and net what I will get is 15.9. Net what will come in hand is only 15.9. Any doubts in this? Then third year it will further go up by 20%. Again I'll have to invest in fixed assets. Investment is going to be 3.6 into 0.7. 3.6 into 0.7. What I will get in hand is 19.08. Any doubts in this? Any doubts on 19.08? Beyond this, it is going to remain stable. The moment it becomes stable, it's a perpetuity. The moment it becomes stable, it's a perpetuity. Only one assumption needs to be taken. The stable amount can be taken as 21.6, can also be taken as 19.08. Can be taken as 21.6, also as 19.08. Now the logic why it will be 19.08 is when you want to maintain your revenues, then also you will have to keep replacing your assets. Your old assets will go off and new assets will keep coming in. A company cannot be in a position to maintain the cash flow without investing in fixed assets. So there are two ways of interpreting. Question is not very clear. You can say that it will continue at 21.6 or will be on level thereafter, or at 19.08. I assume that will continue at 19.08. It's your wish. You can take it as 21.6 also. Now on this year 3 again, perpetuity 19.08 divided by 12%. 19.08 divided. Perpetuity is always valued a year in advance. So from 4th year it is 19.08. I am valuing it in the 3rd year. I am valuing it in the 3rd year, and beyond that 1 divided by you put a total of the DCF, that's the value of the company. You put a total of the DCF. So 15 will become 18, 18 will become 21.6, perfectly fine. But 15 to 18, extra investment in fixed assets. 18 to 21.6, extra investment in fixed assets. I have assumed that whatever amount I see in 3rd year will continue from 4th, 5th, 6th, 7th, 8th perpetuity. I have assumed that it will be 19.08. You can technically take it as 21.6 also. If you take it as 21.6, answer will be slightly different. Clear? Any doubts in this? Clear? Do it now. Let me know in case there are doubts. Some of you look a little confused, so if there are doubts, please let me know. If some number is not clear, do let me know about it. Fourth year onwards. You can technically do the perpetuity value in year 2 also, because 3rd year is also 19.08. But when you value perpetuity in year 2, then you should not write anything in year 3. I'll explain this in some time. You complete this, I'll tell you why perpetuity is valued a year in advance. Done with this? Okay, now please listen. If, see, a perpetuity can be valued at any point of time. It's not necessary that you value it in year 3, year 4. The only rule is it has to become constant. Now, assuming somebody says, I don't want to write the year 3 cash flow and I want to value perpetuity because year 3, 4, 5, every year it is same. Then at the end of year 2, the perpetuity is 19.08 divided by 12%. 19.08. Third year cash flow divided by cost of capital when you value it in year 2. When you value it in year 3, year 4 cash flow divided by the amount. So you get 159. This will be 0.797. You will get the same answer. 152.82. You want to value it in 4th year, you value it in the 4th year by writing the 4th year cash flow. Write the 4th year cash flow, that is year 3, it will be 19.08. Year 4, again 19.08. And year 4 perpetuity valuation is 159. That is year 5, 6, 7, 8. 152.82. You value it in year 4, year 5, year 10, doesn't matter. Why I value it the earliest possible? No need to write so many things again and again, that's all. You want to value it in any year, perpetuity, doesn't matter. The only rule is it has to be valued year in advance. So your 3rd year value if you take, write it in the 2nd year. If you are taking 4th year value, then write it in the 3rd year. Clear? Any doubts on this? Can you proceed? We'll be seeing cash flow based valuation again later on. There's only one problem here, but there will be a lot of problems later on. Go through question 14. Okay. Now let's go through this question. They have given the details of two companies R and S. They're saying decompose the share price of both companies into EPS and P component. This is something which we have been doing continuously. Basically they are saying market price is 50 rupees. Tell us how much is EPS, how much is P multiple. The moment I get EPS, P multiple will become a balancing figure. Also segregate the EPS figure into ROE and book value or intrinsic value. I'll explain this later on as I do it. Future EPS growth rate and some exchange ratio analysis. Working note 1, calculation of EPS, comma P multiple, comma ROE, calculation of EPS, comma P multiple, ROE and book value. EPS, comma P multiple, comma ROE and book value. Particulars and two companies, R Limited, S Limited, R Limited and S Limited. We'll start with earnings after tax in the normal format. I'll stop the format at some place. I'll not do market value of firm and all because that's not required. But let's start with the normal format. Start with EAT. 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 EAT, number of shares. Till market price is the same analysis which we have been doing. EAT, number of shares, EPS, P multiple, MPS, stop at MPS. EAT, number of shares, EPS, P multiple, number of shares. Sorry, market price. EPS, P multiple and MPS. Any doubts till now? This is normal analysis which has been done in almost all questions. We have been doing this in almost all the questions. Any doubts till now? Now EPS is to be further split into ROE and book value. Let me first explain the formula of ROE. What will be the formula for return on equity? Earnings EAES divided by value of equity. Now EAES at a per share level is called as EPS. For a single share it is called as earnings per share, and value of equity for a single share is called as book value per share. So basically ROE into book value per share is equal to EPS. ROE into book value per share. Your ROE is EAES divided by value of equity. This is the overall formula. EAES, when you divide by number of shares, you get EPS. Value of equity, when you divide by number of shares, you get book value. Value of equity means equity capital plus reserves and surplus all put together. You get book value per share. So they are saying this EPS which you see has to be split into two. ROE book value per share. Any doubts on this? Next item, book value per share. Book value per share. Look at the balance sheet and tell me the book value per share. How much? 12 and 10, no? 12 and 10. There's no reserves and surplus itself for S Limited. It's 12 and 10. Any doubts on book value per share? Next, ROE. ROE formula is EPS by book value per share. %22.21% and 15.60%. EAT is split into EPS and P multiple. EPS is split into book value and ROE. Any doubts? Clear? Can you proceed? Any doubts in this? Clear? Now second part, estimate the future EPS growth rate for both the companies. How do I calculate this? Future growth rates for both the company. So how will you arrive? What is the formula? Into? How will you get the growth rate? Into what? Retention ratio into? Formula for growth rate formula. IRR into retention ratio. The other name for IRR is ROE, which is already calculated. I'm going to continue with the same format itself. Next item, retention ratio. Payout is given in the question. Retention ratio. Payout is available in the question. Retention ratio and growth. Retention is 80% and %17.77% and 10.92%. That's the kind of growth which is expected. 17.77 and 10.92. Any doubts in this? Can we proceed? Clear? Now the third one is a little tricky, so I'll first explain this. Based on, can we proceed? Based on operating synergy, P Limited estimated intrinsic value of S Limited would be 25 per share. What is the current market price of S Limited? 20, but the acquiring company believes that the real worth is 25. You are required to develop a range of justifiable equity share exchange ratio that can be offered. Based on your analysis, would you expect negotiated terms to be closer to the upper or the lower? Now, they have told us to devise the exchange ratio. I can go ahead and do it in multiple ways. I'll finally tell what institute has done. One exchange ratio can be based on EPS. I can do an exchange ratio on the basis of EPS. My second exchange ratio can be on the basis of MPS. Third exchange ratio can be on the basis of ROE. It can be on the basis of growth rate. It can be on the basis of your this one intrinsic value. So there are multiple ways based on book value. You have multiple approaches possible. I'll finally tell what institute has done. Institute has done only two approaches: market price and intrinsic value. Market price means base values are 50:20 and exchange ratio is 20:50. Intrinsic value means base values are 50:25. Why 25? Because I believe the other company's worth is 25. My company worth I cannot increase. The exchange ratio will become 25:50. This is lower limit, 0.4:1. Upper limit 0.5:1. Can I have any other approach? Yes. Ideally, you could have added EPS and book value. These are the two extra approaches which could have been added. EPS, MPS, book value and intrinsic value. These four will make more sense here. Institute has done MPS and intrinsic value. MPS is 50:20, 20:50 swapped. Intrinsic values, my value remains as 50, the other value remains as 25. So 50:25 or 25:50. After finding the lower and upper limit, I need to find whether the answer is going to be closer to the lower limit or to the upper limit. That's the next part of the question. Now, to do that, I need to find out which is a stronger company. Again, I am repeating one more important thing. R limited acquiring S limited does not mean R is stronger company. R can be a weaker company, still it will acquire it. R can be a weaker company, but still it will acquire it because maybe it has the financial power, or maybe the transaction has to be done in such a way that R has to become the holding company because of XYZ reasons, from tax point of view or from legal point of view, some XYZ reason. It can be a weaker company acquiring a stronger company, technically called as reverse merger. So it can be a weaker company acquiring a stronger company or a stronger company acquiring a weaker company. That doesn't matter which acquires the other company. Now, between these two entities, which is a stronger company? R is more stronger or S is more stronger? Because of what reason? You need some rationale behind R being a stronger company. It cannot be market price because that is more of a function of number of share. You change the number of shares, market price will change. So tell me certain things which cannot change. Growth, R is stronger. ROE, R is stronger. So these two critical parameters, and another parameter is P multiple. P multiple of R is better than S. So market somewhere feels R is a stronger company than S limited. Next, right, determination of exchange ratio. Determination of exchange ratio. Determination of exchange ratio. Underline that. Formula 1. The first formula is Formula 1 hyphen based on market price. Formula 1 based on market price. Based on market price. Below that, base value is equal to 50:20. Base value is equal to 50:20. Exchange ratio equal to 20:50. Exchange ratio equal to 20:50 OR. 0.4:1 OR 0.4:1. Clear? Next, formula 2 based on intrinsic value. Based on intrinsic value. Base values. Based on intrinsic value. Base value equal to 50:25. 50:25. exchange ratio equal to 25 is to 50. 25 is to 50 or 0.5 is to 1. Or 0.5 is to 1. Clear? Now below that, lower limit equal to 0.4 is to 1. Lower limit equal to 0.4 is to 1. Upper limit equal to 0.5 is to 1. Upper limit equal to 0.5 is to 1. Next point, we expect the exchange ratio. We expect the exchange ratio to be closer. We expect the exchange ratio to be closer to lower limit. To be closer to lower limit. To be closer to lower limit. Full stop. This is because to be closer to lower limit. Full stop. This is because R is a stronger company. This is because R is a stronger company. R is a stronger company. R is a stronger company as reflected. R is a stronger company as reflected in better ROE. As reflected in better ROE, comma, P multiple and growth rate. Better ROE, comma, P multiple and growth rate. Clear? Any doubts on this? Go through question 15. Yep.
Why is R is a stronger company, okay, but how is that making it equal to the lower limit or upper limit?
Because R would like to pay the lowest possible number. S would like to have the highest possible number. No, I am going to give it to you. So I will give you lowest possible number, 0.4 share rather than 0.5 share. So you are asking for 0.5. I am ready to give 0.4. We are now negotiating. Most probably I will win because I am stronger in the discussion. That's what is the scenario.
In any case, then it will always be the lower limit also.
Not in any case. It all depends on how the negotiation happens. It all, see, if I give 0.4, you may reject it also. So it's not necessary that it has to be always.
So as in I'm saying from the question as made, if they ask us this,
No, so if S was a stronger company,
then our base values would have changed,
no, whatever it is, 0.4 is, so the two numbers will be there. It could be 1.5 is to 1, 2.5 is to 1.
We still go for 1.5.
Why will you go for 1.5? Because you are stronger. Why will you agree on 1.5? You are a stronger company. Why will you agree on 1.5? Two options are there, 1.5 and 2.5. Always, I will be telling you that I will give you so less. You will be asking for more. So when we negotiate, whoever is stronger is going to win. No. So if you are stronger, you will take it closer to 2.5. No. Why will you leave at 1.5? Between two numbers, you would opt for the higher number.
So, I mean, how are we saying that the first case it is what R wants and in the second case it is what S wants?
No, what R wants, what S wants is very simple. 0.4 and 0.5. If I give you two options, which will you pick?
I'll always go for a lesser one.
No, no, you are company R. I am telling you I will give you 0.4 share or 0.5 share. What do you want to take? I am giving you an option. You are a shareholder of S Limited. Sorry, you are a shareholder of S Limited. And I am telling you that I can give you 0.4 or 0.5. Which one do you want to opt for? 0.5. You are now a shareholder of R Limited. You are now asking, you can give 0.4 or 0.5. Which one you want to give?
0.4.
So that's why R chooses 0.4, S chooses 0.5. You would like to give a lower number and you would like to take a higher number. No, so the point is, between the two parties, R would like to give as low as possible, S would like to get as high as possible. That's why R is asking for 0.4, S is asking for 0.5. Clear, not clear? Still confusion?
Yes, sir. So what I'm saying is, like, it's base values are always acquiring company is to acquiree company. Right?
ठीक है.
So acquirer company is most of the time on the stronger side.
Most of the times, I agree on it. I'm not saying most of the times it's not there. I only gave a scenario where it is a weaker company.
Saying that acquire the company is the weaker company.
Yeah, your target company is, your acquiring company is weaker, and the target company is stronger. The company which is getting, so in this case, let's take it like this. This is weaker. This is stronger. A rare scenario like this can happen. R Limited is going to acquire, but it's weaker. S Limited is the target, but it is stronger. Can this happen? Yes, it can happen in a practical world. It has happened in the practical world, and it's possible. So in that case, you will have to go ahead and take closer to the upper limit. So you are now under the assumption that always the acquiring company has to be strong.
In that case, then our base value will be 20 is to 50, and then
Correct.
the target will become 50 is to
Correct, I agree.
1.5 is to 1.
So let's assume 20 is to 50, 25 is to 50. The two ratios which will come is 2.5 is to 1 and 2 is to 1. 2.5 is to 1 and 2 is to 1. Now which one will you choose? You will say, give me 2.5, you are stronger. I am weaker, I will opt for 2. So weaker, stronger. You are the stronger company, you will say 2.5. I am the weaker company, I will say 2. Finally, I will have to go ahead and give you 2.5 share. Finally, I am forced to give 2.5 because you are stronger. You will put your terms and make me agree on that. Go through question 15.
So, intrinsic value and book value are not the same.
Ideally, they shouldn't have confused the question by giving this intrinsic value at 25 and used here the word intrinsic value. So, they have kind of confused the question by using that. Ideally, they should have left it at book value. Because when I am doing my comparison at 25, I cannot compare with my book value of 12. Because 12 is to 25, then I will be at a huge disadvantage. The market value of the other company is 20 and they are saying worth is 25. Similarly, my real worth is 50. Don't go by book value of 12. The term intrinsic value does not mean it has to be book value or market value. What explains the real worth of the company? For a listed company, I always believe intrinsic value is market price. Because that is the real worth of the company. That is what markets are ready to pay. Books, you will keep making changes. Sometimes you will say I will not charge depreciation. Sometimes you will not write off bad debts. You will value under FIFO method. You will value under weighted average cost method. All of this will lead to a change in book value. So market is always the prime indicator of the value. Unlisted company, what you say is correct. Book value and intrinsic value is same. They made the question complicated by using book value or intrinsic value there. They ideally shouldn't have done it. Go through the next question. Okay, now coming to this question, they have given details of bank R, bank P. Certain ratios are talked about there, and based on those ratios, they want us to calculate the swap ratio, gross NPA, capital adequacy ratio, market price, book value. Most of this information is readily available in the question, so no calculation. We straight away go ahead and calculate the swap ratio. When we did a similar problem where the weights were given, we had done a 6 columnar format: parameter, base value, exchange ratio, shares to be issued, weight and product. Similar thing we are going to do here now. Let's start. Working note 1, calculation of swap shares to be issued. Calculation of shares to be issued. Calculation of shares to be issued. Parameter, what are the parameters they have given? Gross NPA, capital adequacy ratio, market price, book value. Parameter, gross NPA, capital adequacy ratio, market price, book value. These are the 4 parameters they have given. Base values. Which is acquiring which bank? P is acquiring R. Tell me the NPA of P and R. Gross NPA of P and then gross NPA of R. Everything will be available in the question. Gross NPA of P and gross NPA of R. 5% and? Okay, right, 5:40. 5:40, gross NPA. Bank P vis-a-vis bank R. Capital adequacy ratio of bank P and bank R. Base values, I am just bank P, what is the capital adequacy ratio? Bank R, what is the capital adequacy? 16:4. 16:4. Market price 128:8. Book value, no, that is overall value, no, per share. Is the face value given somewhere? Take face value as 10 and do it. For both, take it as 10 and do it. Take the face value to be 10 and let me know the book value. Book value as 10 rupees. How much? How 600? It will be 6,000 divided by 50 lakh shares, no? 6,000 divided by 50 lakh share, 210 divided by 14 lakh shares. 6,000 divided by 50 lakh and 210 divided by 14. 10 rupee per share is the assumption. Both are same. How much you get? Okay, now the critical adjustment. Any doubts on the base value? We have just copied whatever the information is given in the question. Exchange ratio. Listen for some time. 15:120, I have swapped it. 8:128, I have swapped it. 4:16, I have swapped it. 5:40, I am not going to swap it. Why I am not swapping, I will explain now. Any parameter which we have done till now, parameters are always have been favorable parameters. Always the parameters has been EPS. See, any parameter given in the question, if the objective is to maximize that parameter, then only you should do the swapping. For example, I would like to maximize book value. I would like to maximize market price. I would like to maximize capital adequacy ratio. Higher the capital adequacy ratio, better it is. Would you like to maximize gross NPA? Whether the objective would be to maximize gross NPA? No, the objective is to minimize gross NPA, and in that case, lower the value, better it is. Lower the value, better it is. So 5:40 itself indicates which is stronger, which is weaker. If I swap it, then it will become the wrong calculation. So for any negative parameter like attrition, if attrition is one of the parameter, then I am not going to swap the parameter. Cost of equity, I am not going to swap it. We are not going to swap items like cost of equity, attrition rate, gross NPA, net NPA, losses. All these parameters can't be swapped because those parameters on its standalone basis itself are swapped. Why we are swapping? The swapping is done just to get the proper exchange ratio. Ideally, this is just a shortcut. When I give you the numbers, you should be in a position to tell me if 120 and 15 means 1 share for 8 share or 8 share for 1 share. That is, every parameter you need to think and write it. We have been simply doing swapping and closing it, but I cannot do that swapping business for negative parameters. 5:40 itself indicates which is weaker, which is stronger. So 5:40 means bank P, which is 5%, is a stronger bank vis-a-vis bank R, which is 40%. So this itself indicates which is weaker and which is stronger. I straight away go and do 1:8. 5:40, straight away I apply the exchange ratio rather than swapping and making it incorrect. Because the moment you swap it, it will become 40 shares for 5 shares. Whereas I don't want to give 40 for 5. I want to give only 5 for 40. Any doubts on this? So any negative parameter, the base value is the exchange ratio. Any favorable parameter, the swapped value is the exchange ratio. Why for favorable parameters we have to do swapping? Because the objective is to maximize them. So what is a negative parameter? A parameter which you want to minimize. Any parameter which you want to minimize. Example, provision for doubtful debts. If provision for doubtful debts is there, I am going to, my plan is to minimize operating cycle. Operating cycle is the number of days you collect the money. That those parameters, if they come, the objective is to always minimize them rather than maximizing them. So for any negative parameters, you are going to take the base value as the exchange ratio. Beyond this, you do it. Shares to be issued, weight and product. Beyond this, it's your job. Share to be issued, weight and product. The only thing which I wanted to explain is gross NPA will not be swapped. Your exchange ratio is 1,75,000 is to 14 lakhs. 0.125 is to 1 or 1 is to 8. That's basically the exchange ratio. 1,75,000 is to 14 lakhs. Any doubts in this? Swap ratio 1,75,000 is to 14 lakhs. 0.125 is to 1. Any doubts on this? That answers part 1 of the question. How many shares are to be issued? Both are done. Part 1 and part 2 is done. How many shares are to be issued is done. Balance sheet after merger. Balance sheet after merger is you just need to add both these balance sheets. Now only thing is the consideration is 1,75,000 shares. We are allotting shares at what they have said. It was decided to issue shares at book value of bank P. What is the book value of bank P? 120. So listen, 1,75,000 into 120. This is what is your accounting standard says as consideration. 1,75,000 into 120. How much is this? 210 lakhs. Now please listen. When I prepare the combined balance sheet, it will become 100 plus 2,000, 3,500 plus 27,000, 1,100 plus 15,000, 0 plus 2,000, 400 plus 2,500, 890 plus 2,500, 400 plus 40,000. All of this will be added. Paid up capital will become 500 plus 1.75 into 10. Because your issues balance amount 5,500 plus 1.75 into 110. This is your securities premium. The earlier part is called as share capital. Now in this transaction, there is no goodwill or capital reserve. Otherwise, that will also come into picture. You would have learnt about goodwill, capital reserve earlier in amalgamation. In this question, all of that is not there. So I straight away just add the numbers. We are just adding the two numbers and making the combined balance sheet. No goodwill, no capital reserve, because consideration is 210 lakhs. Assets taken over is also 210 lakhs. Clear? Any doubts in this? Now let's do combined balance sheet. Combined balance sheet. Particulars calculation amount. Combined balance sheet. Particulars calculation amount. Combined balance sheet. Particulars calculation amount. In particulars, write liabilities and underline that. Liabilities and underline that. Liabilities and underline that. Share capital. Share capital 500 plus 1.75 into 10. 500 plus 1.75 into 10. $500 plus 1.75 into 10. Reserves and surplus. Reserves and surplus 5,500 plus 1.75 into 110. 5,500 plus 1.75 into 110. Balance you keep adding it, that's all. Deposit add, liabilities add, total, cash, balance, everything added, your balance sheet will tally. Which one? 1.75 into 10. 1,75,000 shares into 10 rupees face value. 1,75,000 shares into 10. Into 10. 1,75,000 shares into 10. Balance 110 is securities premium. You are allotting shares at the rate of 120. 10 rupees is face value. Balance 110 is your securities premium. complete the balance sheet will tally. I'll then proceed to the next part. Any doubts on this? Now, can I go to the next part? Now, okay, they've asked for, listen for some time, any doubts? They've asked for capital adequacy ratio and gross NPA percentage of bank P after merger. Whenever two things are merged and you want to get the value of the other one, it's basically doing a weighted average of the two values. So, listen. Entity, it's basically this format: source, cost, weight and product. The same format I'm going to use here. I'll write it as entity. The first thing they're asking is capital adequacy ratio. Entity, capital adequacy ratio, weight and product. Entity, capital adequacy ratio, weight and product. Bank R, bank P. Then we have merged bank. What was the capital adequacy ratio of bank R? 4%. Bank P? 16%. Now, we'll have to see how they are calculating capital adequacy ratio. They are saying capital adequacy ratio CAR by CRAR. That is capital adequacy ratio divided by capital risk weight asset ratio at 4%. In short, what is capital adequacy ratio is how much capital has the company brought in, the amount of capital the company is bringing in as compared to the risk weighted assets which it has. Risk weighted assets is every assets you see here, there is a risk weight attached to it. Cash will have a risk weight of 0% because nothing can fall, but advances, investment, all of this will have a risk weight. So based on the risk weighted assets and the capital which a company has, you get capital adequacy ratio. So the formula for capital adequacy ratio is capital divided by risk weighted assets. Capital divided by risk weighted assets. Now listen, what is the capital of bank R? Capital plus reserves and surplus all put together. Bank R 210 lakhs. Bank P 6,000 lakhs. This indicates they will have a risk weighted assets of so much. 5,250 risk weighted assets and 37,500 worth of risk weighted assets. The product is basically, the formula for capital adequacy ratio is capital divided by risk weighted assets. Capital divided by risk weighted assets. In short, the risk weighted assets is capital divided by capital adequacy ratio. So in this question, entity CAR, weight in bracket, risk weighted assets, product in bracket, capital. The moment merger happens, you add them, you add this also, but you cannot add the CAR, so you take a weighted average, and that weighted average is 14.53%. Anywhere you have to do a weighted average or merged values, you will use this format: source, cost, weight, product. Source in this case is called as entity, cost in this case is called as capital adequacy ratio, weight in this case is called as risk weighted assets, and product in this case is called as capital. See, always this, any formula, this is the denominator and this is the numerator for any formula you use. So when we use WACC, sum of product by sum of weights used to be the formula. So denominator will come in the weight and numerator will come in the product. Clear? Any doubts in this? Do this and then we do the next ratio. Anywhere you have to do a weighted average, please keep thinking about this format. I'll keep using it in multiple places. So it is source, cost, denominator, numerator. Let's call it like that. Source, cost, denominator and numerator. Source, cost, denominator and numerator. Can I go to the next one? Next one they've asked. Yeah, sure. It is source, cost, denominator, numerator. Let's keep it like that for every formula, because I'll keep using this at multiple places. This is going to be there in portfolio, derivatives, at multiple places this will get used. Can we proceed? Now, they have second part, they've asked us gross NPA percentage. Wait for some time. It will be entity GNPA percentage. Can you tell me how will you calculate gross NPA percentage? Accordingly, I tell what is the third and the fourth column. How will you calculate NPA percentage? Amount of NPA divided by total advances. Amount of NPA divided by total advances. So this part is going to be total advances and this part is going to be amount of NPA. Beyond this, it's your job. You will complete it. Entity NPA percentage, weight is advances, product is amount of NPA. Entity GNPA percentage, weight which is advances and product which is amount of NPA. Entity GNPA percentage, weight and product. Any doubts on this? Clear? Can we proceed? Any doubts on this? Let's do the pending problem which was there. Go through this question, question 8. Go through question 8. Okay. Now coming to this, they are saying about two banks which are planning to merge. They want us to calculate expected value of debt and equity separately for the merged entity. I'll tell you what is to be done. There is a logical disconnect with the solution also, and there is an issue with the question. I'll explain all of that as I'm done with the solution. Now what is expected value of debt and expected value of equities? Let's take an example of Centurion Bank. In a high growth phase, the Centurion Bank will have a value of 820. Of this 820, 460 will go to debt, guys. Balance will come to equity, guys. 460 has to go to debt because debt are the primary value holder. It is debt plus equity value. So the first 460 will go to debt, residual will come to equity. Medium growth, 460 will go to debt, balance will come to equity. But in the slow growth phase, equity guys will lose their money and debt guys will also lose their money. Limited liability, so debt guys will also lose their money. Weighted average, all of this is called as expected value of debt and expected value of equity. I'll have to do it separately for Centurion, separately for Bank of Punjab, and then add it up both. That's called as the separate valuation. The disconnect part I'll explain as I'm done with this. Working note 1, expected value of debt and equity of Centurion Bank. Expected value of debt and equity of Centurion Bank. Value of debt and equity of Centurion Bank. You will require some 7-8 columns. Manage space accordingly. Business condition. Business condition. Some 7-8 columns will be required. High growth, high, medium and slow. High, medium and slow. High growth, medium growth and slow growth. Probability 0.2, 0.6 and 0.2. Probability 0.2, 0.6 and 0.2. Company value is 820, 550 and 410. 820, 550 and 410. Now a part of value will go to debt, balance will go to equity if at all anything is left. Value of debt. Value of debt. value of debt 460, 460. Third scenario alone it will be 410. The next one is product. You will multiply with the probabilities. There's a logical disconnect with the question. I'll explain that in the end. Product now basically this ideally would have been 460 itself, but in one scenario debt guys are going to lose something. Now equity is a balancing figure and product. Equity is a balancing figure and there is a product. Whenever probability is there, expected value means you have to multiply with probability. The term expected means you will have to multiply with the probabilities. So different scenarios has different probability. I'll have to obviously multiply with them. Any problem, probabilities are given, it means you have to do the multiplication and get the answer. So the value of expected value of debt is 450 lakhs. Expected value of equity is 126 lakhs. This is nothing but the expected value of debt plus equity, which is, if I had done any doubts till now, 450 and 126. This total is 576, which is nothing but 450 plus 126. We have split that 576 as 450 and 126. Debt guys are also losing something in one of the scenario. Now do the same thing for the other bank. Same columns. Expected value of debt and equity of Bank of Punjab. Not a technical issue, that's because you lost here. Instead of writing 460, you wrote only 410. So there is a loss for the debt guys. I'll just explain. Let me just complete this. When I come to the merged one, I'll explain. Okay. Can I come to the final solution which Institute has given? Now, what Institute has done in the final solution is they have said expected value of debt is going to be 450 plus 65 for the merged entity. For the equity part, they have just added 758 and 126. There is a small logical disconnect to this. The logical disconnect is when merger happens, both get added together. The moment both get added together, in this scenario, debt holders were losing some money. They will not lose it because they will recover it from Bank of Punjab's money. They are not going to lose the money itself. So that's a logical disconnect with the question. I'm not sure why they are justifying it. Maybe because of the word separately used, that's how they have done it. But the logical part is the moment merger happens, it is no more Centurion Bank and no more Bank of Punjab. And it's no more debt of 65 and 460. It is debt of 65 plus 460. So ideally, first 525 should go to debt, guys. And balance only will come to equity, guys. So that is what an ideal answer should be. Institute hasn't done it. This part is correct. That is, doing separately Centurion Bank is fine. Doing separately Bank of Punjab is also fine, but you cannot add them. They are not addable because in this scenario, the loss is happening. This will never be 410. The moment the merger happens, this will also change as 460. And if it changes as 460, this will also change as 460 because it's just an addition of 460, 460 and 460. Weighted average of that will turn out to be 460 itself. We will leave it whatever Institute has done. So as far as Institute solution is concerned, you will have to take it as 515 and 884. Expected value of debt of merged entity 450 plus 65. Expected value of equity of merged entity 126 plus 758. Not sure, they may repeat this question in exam. So that's why I'm doing it. Otherwise, this is the disconnect with the question. Complete this, then we'll take a break of 15 minutes.